Welcome to Remarkable Retail Podcast, Season 10, Episode 16. I'm Michael LeBlanc.
And I'm Steve Dennis.
In this episode, we welcome back to the podcast for a special two-part episode Andrew Lipsman, one of the world's foremost experts in retail media networks, to discuss the state of the retail media nation, opportunities, some challenges. Steve, this is the second time we've gotten halfway through an interview with a highly respected thought leader and texted each other that this was actually a two-part episode. Too much brain power to fit into a single show this time.
Yeah, well, Andrew, as people will hear, shares a lot of knowledge. I think people will find it super interesting. It's also just interesting to take another deep dive into retail media networks a few years on, because it was a while ago that we had Andrew on. So folks will hear a little bit about that as well. But yeah, lots of great insights that I think everybody will enjoy and benefit from.
Now, last week we marked the 5th anniversary of the release of your first book, Remarkable Retail. Congrats again on the durable insights and thoughts from that bestseller.
Durable insights.
Durable insights.
I like that. I'm going to have to use that.
But wait, that's not all. Your second bestseller, Leader's Leap, is celebrating a milestone as well.
Yeah, it's the 1 year. It's just April's apparently a big month for me to put books out, since first and second edition of Remarkable Retail came out the first half of April, and Leader's Leap came out in the second half of April. Yes, so today is the 1 year anniversary. So if folks haven't checked Leader's Leap out, I hope they will. And just to make it a little bit extra interesting, first of all, you can get the Kindle edition for only $9.99 on Amazon. But also, if you're interested in getting a signed copy or buying in bulk, I will post some hot deals on LinkedIn. So look for that. And those low prices are, it's not a tariff related sale, by the way. We're going to talk about that in a minute. This is irrespective of tariffs, but look for those discounts on LinkedIn, and those are good through the end of April.
All right, well, let's get into the news. A relatively quiet week, so to speak, on the tariff front, if not the rule of law front. Can we spend some time just to kick things off on the implications on Brand USA? I was thinking about this. I was doing a keynote in Savannah, Georgia, and I mentioned to the folks there who were focused on the tourism business in America. I said, listen, stats out from Canada, for example, the cross-border traffic is down 37% in March. That's 900,000 less visits. And then I noticed California's Gavin Newsom launched a "We Still Love You, Canada. It's not our fault."
The Golden State and Canada have always shared so much in common. Sure, you know who's trying to stir things up back in D.C., but don't let that ruin your beach plans. Last year, nearly 2 million Canadians visited California, because here in California, we've got plenty of sunshine and a whole lot of love for our neighbors up north.
Kind of ad to try and salvage the tourist season. I guess kick it off with, if there's not a lot of tariff announcements this week, we're starting to get the implications of all this stuff, right?
Well, you raise a good one. I mean, there are a lot of statistics, the ones you mentioned from Canada. I saw an article in the New York Times, I think about a week ago, about the big drop from tourists from Europe. And I guess if you think about Brand USA a little bit more holistically outside of the tourism aspect, been a real flight away from U.S. Treasury bonds, which has driven interest rates up. So maybe we'll talk about that in a minute. Pretty big implications in terms of interest in U.S. products, but also the service side and also the financing side. So when you start to add that all up, and I think we're still just starting to really see the direct impact of that, what's this summer going to look like for hoteliers and restaurateurs in some of the big tourist cities? I mean, they could have quite significant drops. I also know from my Neiman Marcus, Bergdorf Goodman experience and some of our cities like New York, San Francisco, Miami, Chicago, 5 to 10% of the business during peak tourist times could be coming from international tourists. So the ripple effects are potentially quite significant.
Take us through some of the your observations, kind of from a macro, some economics, and just how retailers are thinking about things like cash flow and what to do. And there's lots of stories out there. Like I said, we're all starting to really unpack the implications of what's happening.
Yeah, I'll try to keep this pretty brief. Again, we've talked about tariffs every week, and probably at this point we will talk about tariffs every week for a while. But one of the things I thought was really interesting is I heard a couple people talk about a few things related to uncertainty. And we've talked many times about how uncertainty is really one of the things that is causing some of these economic impacts. I heard one guy say that he actually thinks that the uncertainty is worse than COVID. Not the first few weeks of COVID, but once we started to realize, okay, things are going to start to open up. But from a business standpoint, you could kind of see a path out of it, even though it was unclear how quickly things were going to come back. Here, it's just like, we don't know. We don't know whether tariffs are going to be high, moderate, or low. We don't know when we're going to see any significant change. So that was kind of an interesting perspective. Another perspective I heard was, well, maybe, though, we are at peak uncertainty, that from here on out, we've got to start to see more certainty. But again, the pace of that and the degree of that really remains to be seen. We did get some, and again, our standard caveat here, by the time people listen to this, maybe there'll be some breaking news that we don't have as we record this. But this 90-day pause that the Trump administration put on to work out some deals, apparently meetings are going on, but nothing concrete has come out yet. And there aren't even really any rumors of the types of deals that might be possible with, I think the president met with Japan and Italy and a few other leaders this week, and a bunch of meetings are coming up. So lots still very much TBD. I think the biggest piece of news of last week was the fight that's emerged between Chairman of the Federal Reserve, Jerome Powell, and the president. Jay Powell said in a meeting in Chicago, where he worked in a little Ben Stein, Ferris Bueller reference, which some of you may know.
In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the the Great Depression, passed the the tariff bill, the Hawley-Smoot Tariff Act, which raised or lowered, raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone know the effects? It did not work, and the United States.
But what he said, and usually the Federal Reserve chairs are quite careful about saying anything that looks to be political or is critical of the administration. But the specific thing he said, and I'm going to read it, is the proposed tariffs are significantly larger than anticipated, and the economic effects will include higher inflation and slower growth, which is really what everybody else has been saying. But because of who he is, that carried quite a bit of import, sent the stock market down, but it also led the toddler-in-chief to go after Jay Powell with some nasty comments. So anyway, the Fed is now kind of, I think we talked about this a little bit last week, the Fed is kind of boxed in because of the dual mandate. The unemployment picture looks pretty good, but the inflation picture, which was improving, as we all know by now, is starting to look like it could be going the other direction, which means they are unlikely to reduce interest rates anytime soon. The other thing is the Trump administration is kind of getting boxed in as well. I think we touched on this a couple of weeks ago, and not to go too in the weeds on this, but the budget process is going on. They're trying to sort out how to not have the deficit explode while also reducing taxes. Tariffs are meant to be a big source of revenue. The boxing in, though, now is that because interest rates are now like 0.5% higher than were anticipated when the budget process started, that just adds a lot of interest, like hundreds of billions of dollars in interest to the equation. And it also looks like growth is going to be much slower, which presumably means taxes will be lower. And if retailers, for example, or other businesses eat some of the tariff cost, they will have lower profits, which means they will pay lower taxes. So you get a situation where revenues could be lower, trying to sort through the expenses, but ballooning interest rates are causing a lot of problems. So this explains interest rates staying high, dollar weakness, a whole bunch of other things. So it's really a mess, at the risk of stating the obvious. But anyway, moving on, just a few other things, and we can move on to other news. You mentioned the tourism impact, but I think we're starting to see much more tangible impacts from both the uncertainty as well as the tariffs starting to work their way into the system. So I'm just going to run through a few. So we got the monthly sales report for the U.S., retail sales report from both the CNBC monitor as well as the U.S. Census Bureau. And it was actually a pretty solid month for retail overall. But what was most interesting to me was that furniture and autos had like the highest sales increase they've had in a long time. And of course, everybody's interpretation is people are buying to get ahead of the tariffs. And so we also saw a report from Momentum Commerce where they studied some of the Amazon trends. And they also saw evidence that people were buying forward products that were very exposed, weren't fresh products, but products with a shelf life that were relatively expensive. So they saw a shift in trend there. So I think there's a lot of evidence of this pull forward of demand, which presumably will continue in this month's numbers as well. Then you've got things like Shein and Temu raising their prices. This is both a function of being subject to Chinese tariffs, since so much of the product comes from China, but also the elimination of the de minimis exemption. So they've announced that they're raising prices effective this week, April 25th. And they've also pulled back.
That's a really interesting one to watch, eh? That's a super interesting one to watch, because they've long claimed that, listen, that's not really, we're past that being an advantage. That might have bootstrapped us up, but really we're so good at what we do that we can now basically fight on a level playing field. I'm not so sure.
Well, there are, this is something I think people misunderstand about it. They have other advantages. I think we touched on this a little bit last week of their ability to find trend right product very quickly and produce it and do it in test quantities. And they basically have no markdown, no excess inventory. So there are other advantages of their model relative to some of their direct competitors. But layering on this extra price presumably is going to have a material impact on their demand. They're also, I assume, just trying to right-size their costs. They're also pulling back on their advertising in the U.S. So that's good news if you're a direct competitor of Shein and Temu, I suppose. In the luxury market, I guess another thing related to the Chinese market I'll mention quickly is lots of evidence of Chinese companies dumping product into the UK and the EU and around the globe because they don't have, they're losing, not completely, obviously, but they're losing a lot of volume that they would normally get to the U.S. So products kind of backing up and they're trying to find outlets for it. So that could have some interesting effects, I suppose, on pricing and competitive dynamics, at least in the short term. In the luxury market, going the other end of the spectrum, and we'll talk about Hermes a bit more in another piece of news in a minute, but they have said that they will be raising prices basically right away, even though their costs are not necessarily going up. And also in an interview that Mark Metrick, the chairman of Saks Global, did with Women's Wear Daily, he said he expected prices to go up in the 10 to 12% range in the not too distant future because, in particular, because of tariffs on European, so much of the product comes from Europe, though. A fair amount of that is made in China, Vietnam, and other places as well. We're starting to see things like tariff surcharges on receipts, where retailers are saying, here's my price, but here's the extra price we're layering on because of tariffs. The one I think is really going to be interesting to watch, and I'm sure hear a lot more about this in a few weeks, is what's going on with the supply chain and shipping, basically because of U.S. retailers cutting back on products from China. The ships are starting to not get filled up and not start to come across to the U.S. So
stuff's sitting on the dock, right? It's been held back. It's sitting on the dock. The Chinese manufacturers are holding it in warehouse, and boy, that's going to create such a bottleneck soon, right?
Absolutely,
it's a hard problem, right?
Probably going to see. You can go to the L.A. ports and not see a lot of activity probably in a few weeks. Another thing this kind of harkens back to an episode we had a few weeks back with Barry Scardina from Cushman & Wakefield, and folks that listen to that will remember that part of what we talked about was the strength in leasing generally. But Cushman & Wakefield just put out a new report saying that the first quarter of 2025 was the weakest they had seen since the pandemic. And there's a bunch of anecdotal evidence that from other people in the real estate industry saying that retailers have basically not completely stopped signing leases, but have cut back a lot because of the economic uncertainty. Just a couple quick things, getting to the end of this, but housing market also, which is, we've talked about a bunch of times, has kind of been frozen because of high interest rates and some other economic factors. The hope was, of course, that it would start to thaw a little bit as interest rates started to come down, but interest rates have gone the other way. And cost of construction materials, lumber, steel, et cetera, are going up. Potential labor shortages because of what's going on with the immigration policies. Well, anyway, the net of that is housing starts fell year over year by 11%. So that's a obviously quite significant number, but the U.S. has a housing shortage. So that obviously,
it wasn't in a great place to begin with, right?
Yeah. The last thing I'll mention, kind of two things that are out there on other podcasts, not to promote other podcasts, but the Daily New York Times podcast, which some people will know is one of the most popular podcasts in the world. They had a really interesting episode. We'll put a link in the show notes where they interviewed a startup founder. Well, their company's not so small anymore. They've been growing really nicely. She makes baby products. It's a real kind of rags to riches story, very inspiring. Story. Yeah. She actually, just in the past 6 months or so, got, selling in e-commerce, selling to independent retailers, actually has gotten into Target and Walmart, which of course means she needs to raise a bunch of money to fund the inventory. But almost all of her product is made in China. So now she's got to come up with money. She's got this whole pricing dynamic, but she's got to come up with money to actually get the product off the ships. In a similar vein, on the Pivot podcast last week, Kara and Scott talked about, Scott told the story about, I'm pretty sure I know who he was talking about, but a major furniture retailer, which has product coming over from China. And apparently in order to get the product off the boat, they have to write a check for tens of millions of dollars that was unplanned. So you just think about this, both from the small players and the big players, the cash implications of, product that, well, first of all, you weren't planning for this, but also, you're not going to get paid by the consumer or, in the case of a wholesaler, you're not going to get paid for 60, 90, 120 days. So this is really, I think, a big story that we're going to see more and more. All right, enough about tariffs. Let's move on.
Like we always say, we tried to make the news short, but there's so much news going on that's so crucial to our audience that we just want to take these kind of steps to just point these things out because they're just, let's move on to other standard kind of news, so to speak. LVMH kind of surprises in a bit of a way with some weak sales. Talk about it.
Yeah, they had a pretty tough quarter. Their business has been decelerating a little bit. I think what's probably going on here is, for the most part, I know from my experience in luxury, when economic conditions get more difficult, the really high-end consumer more or less keeps spending. Or they might slow down a little bit, but it's not significant. But the more aspirational, accessible luxury customer really cuts back because it's an easy thing for them to eliminate because it's more want than need, and they need to spend on nothing. So pretty much across the board, LVMH was weak. The two weaker segments were the spirits business. Folks may know they own quite a few champagne houses and other liquor manufacturers. Whether that's a function of that's something to cut back on, whether that's a function of, there's been a longer term trend towards, downward, not drinking alcohol. We've seen a lot of folks report that when they're on the GLP-1 drugs, their craving for alcohol and other kind of stimulants and mind-numbing kinds of activities goes down. So it may be a bunch of things. But the beauty business, the Sephora business, was also comparatively weak. And there had been some sense that TikTok and other niche kind of beauty influencer kind of businesses and maybe are really growing disproportionately. Anyway, it's a little hard to unpack. But two other little interesting tidbits related to the LVMH earnings report is Hermes, which is a considerably smaller business than 1/3 the revenue of LVMH, now has a market valuation greater than LVMH. And that I think is really, it's a little crazy to kind of sync up the numbers, but LVMH actually tried to buy Hermes a number of years ago, and the Hermes family kept the business, which looks like a good move. So some changing fortunes there among the most prestigious luxury houses.
Sticking with beauty, Ulta pausing its expansion plans with Target. Both have been in the news lately. Talk about it.
Yeah, I think a few weeks ago we talked about there have been some rumors that Ulta and Target were having some struggles. And some of the reporting around that was that the Target numbers weren't so great and some execution issues. And of course, Target, as we've talked about a bunch of times now, has had quite a bit of struggle over the last couple of years, but most recently with some of the reports about their traffic being weighed down like 10 straight weeks. And this has been tied back to some of the protests to their backing off of their DE&I initiatives. So it's a little unclear what's going on here. Now, Ulta, and we've got an Ulta executive coming on the pod in a few weeks, but Ulta has a relatively new CEO, Kessia Steelman. She actually oversaw the Ulta and Target partnership, so she's very familiar with that. So one theory is that with Target's struggles, why would you want to expand anymore, particularly in a challenging economic environment when it's not clear what the direction of that business is going to be, and maybe you want to spend your energies and capital on other things that look to have a more clear return. Or, it could be that she's new and she's just taking a look at everything, and if some of the numbers are questionable. But give a little credit to our friends Chris Walton and Ann Mazinga, because they pointed out that in Target's most recent earnings report, they said beauty was one of their strongest segments and that sales were up 7%. Now, they do sell other beauty products that aren't just Ulta, but it's a little hard to say, well, is Ulta really performing that poorly? How do you do a 7% number, particularly when Target's overall business is down? So it's a little hard to tell what's going on here. So this may just be a pause as a kind of recalibration, or there may be more trouble in paradise. But Ulta, has got their hands full with, competing against Sephora and competing against, as we just talked about, some of the things going on with TikTok shops and some other more niche competitors.
Well, let's wrap this not so positive news episode with some positive news in the retail space with IKEA. Talk about what's going on in Texas.
Well, IKEA, as some of our listeners will know, has been experimenting with a smaller store format, sometimes referred to as a city format, though not all these smaller stores are center urban kind of stores, but they look like they're starting to step on the gas. We've gotten a few other announcements about some openings during the past year, but they just announced that they're going to be opening 3 stores in Texas, ranging in size from 35,000 square feet to 65,000. So folks that know IKEA will know that is a lot smaller. I think most of their stores start at 250,000 square feet plus. So more limited assortment. They'll still have some food offering, be kind of an omni-channel fulfillment kind of thing, design studio. So one is going to be here in Dallas, actually just about a mile and a half from where I live. One is in a suburb to the east of Dallas called Rockwell. And then the third one will be down in San Marcos, which is a town that's it's kind of a suburb of Austin. So interesting. It seems like they've got a lot more confidence about that. And I think it's an interesting compliment. So here in Dallas, there are 2, Dallas-Fort Worth area, there are 2 core format IKEA stores, but they would be a good 15 or 20 miles away from where these stores will be located. So they're, kind of covering the geography with kind of a hub and spoke system. So very interesting strategy to watch. And that'll be opening. I think all 3 of those stores will be open later this year.
Well, it'll be interesting to watch because the small store strategy trend, or the small store trend, has been kind of a little bit rocky, ups, downs, and sideways. So let's see how IKEA does. All right, well, that's a wrap on the news for this week. Let's now get to part 1 of our 2-part episode with Andrew Lipsman talking about retail media.
Well, Andrew Lipsman, welcome back to the Remarkable Retail Podcast. We're so excited to have you on. How are you today?
I'm doing great, Steve, Michael. It's great to be here again.
And do we find you in Chicago, or where do we find you in this great world of ours?
Chicago, just outside. Yep.
As maybe we'll touch on a little bit later in the podcast, you and I spent some quality time in Bucharest, Romania, of all places, and got to share our mutual Chicago experiences. So, but maybe we'll save that for later, another time. But why don't we get things started just by having you tell us or our audience, I should say, a little bit about who you are and what you do.
I am an independent analyst and consultant for media, ads, and commerce. That's my consultancy. I also work for another consultancy with a few partners called Coliseum Strategy. And I guess my game these days is primarily retail media. So I'm doing a lot of work in the space, working with retailers, tech companies, measurement companies, and everything in between. So it's kind of all things retail media these days for me.
Now, when you were growing up, was it always your dream to be a leading expert on retail media networks? Or how did you end up in what has turned out to be an extremely hot part of the retail world?
Well, I had no idea. Obviously, we didn't know that retail media was going to be a thing. I've spent most of my career, really all of my career, in digital media, advertising, and commerce. That's the origin of the name of my company. And it's kind of unique that these things have all dovetailed here and converged in different ways. But I think the most prominent way they've converged has been in retail media. So because I've spent a lot of time in understanding retail and e-commerce and then digital advertising, it was very natural for me to kind of see the trend, understand the trend, and why it was going to be. I thought it was very destined to be a big thing early on. And thus far, obviously, it's proved to be true.
And when did you, first realize how big retail media networks were going to be? And then, what spurred you to take the leap to focus in that area? And then, fairly recently, go off on your own?
Sure. So prior to going off on my own, I was a retail and e-commerce analyst at eMarketer for about 5 years. And actually, the moment that I realized retail media was going to be a thing was very early into my tenure there. It was about 2018. And one of my fellow analysts, Nicole Perrin, who covered digital advertising, had just written a report that the subhead for the report said Amazon is now the number 3 ad seller in the US. And I was covering Amazon on the retail and e-commerce side. And I was like, oh, that's really interesting. And I thought about it for a half second. And I was like, oh, well, these are Google ads in the context of an e-commerce website. It's Google ads on steroids. So if you think that Google ads are the greatest advertising machine in history, how much more impactful is it going to be in the context of e-commerce? So it was just that moment where I realized how powerful it was going to be and that it would extend well beyond Amazon to other retailers. And then I thought about it more and I was like, well, they've got this amazing data, right? The data is actually data on what people are purchasing and shopping for, what brands they buy. That's more valuable targeting data than some random behavioral data embedded in cookies, which most of the time is not even accurate in the first place. And then the last piece of my thinking was, we don't even have digital in store yet. So I thought about digital screens in store and kind of hypothesized that would become a big part of the equation eventually. So all of these things formulated. I wrote my first report on retail media networks in 2019, where I laid out the 3 primary channels of retail media, and it's kind of manifested in that way. The one thing I did get wrong was I said with respect to in-store media, I thought that in-store media would have to be personalized and targeted like other forms of advertising in retail media. And I thought that, it'd have to communicate with your phone in order to understand who you are and then give you a personalized ad on these digital screens. Not to say that there aren't folks who want to make that happen. I think there are. I think it is the wrong approach for in-store media. We could probably talk a lot more about the CX implications of that in a bit. And ultimately, that I just didn't think that was the best prediction that I had with respect to retail media.
Maybe it's just a matter of time. See, most of my predictions come true if you just wait long enough. That seems to be the way it works.
We'll find out, but I'm hoping that retailers see it as primarily a one-to-many medium and not a one-to-one medium.
Well, it's been 2.5 years since this discussion between us started happening. I remember the day very clearly, Steve, we should be talking about this retail media and notwithstanding Amazon and some others, it was really just a glimmer in the eye of retailers, right? It was like, I don't get it. Is this kind of like, aren't we doing shopper marketing just a different way? Some of the grocers, So I still talk to retailers and folks in the industry who are still not quite clear. So we probably should spend a minute about what retail media networks are and what the differences is. Just to kind of ground our conversation, but also I do still find there's some confusion. We're going to hopefully blow that confusion up after the end of this discussion. But let's start there. What is a retail media network?
Yeah, a retail media network is just the advertising arm of different retailers. And so in a sense, they're becoming media companies, although some would argue they've always been media companies to some extent, right? Media has always been a part of trying to drive sales. So obviously, as advertising has become digital, we've seen it in these three different ways: on-site, in-store. So that's the owned and operated placements for retail media, and then obviously using that data that we just talked about for targeting. And that targeting can happen on the open web, can happen on social platforms, it can happen on streaming TV, things of that nature.
So here's a question, a roundabout way, but let's be precise. Where does this money come from? Because the money isn't incremental. I'm sure someone's got to find it somewhere, someone being a vendor, let's say. Is this really a play to take money away from, let's call them, the platforms and move it into spending it with retailers? Is that how the retailers think about it?
Well, retailers certainly they don't want the money just coming from shopper and trade and shifting, right? They want net new revenues. And in different forecasts from big consulting firms, in which I broadly agree with, suggest that the vast majority, maybe as much as 3/4 of the revenues going into retail media are actually incremental. And that other 25% or so, it will come from shopper and trade. So where do the dollars come from? Well, first, incremental spend does happen every year. There tends to be an increase over time. It's just those incremental advertising dollars disproportionately are going to retail media. Okay. It will pull from other channels like TV, Meta, open web, Google. So it's going to pull from some of the other big buckets as well. But I think the piece that most miss with these projections of how much retail media is supposed to grow are that a lot of it is just new money from non-advertisers. So if you think about what has helped Amazon grow to a $50 billion plus ad business, it's third-party sellers, right? It's not as much the big brands. They're certainly part of the equation, but it's third-party sellers. And those third-party sellers went from being a non-advertiser to an advertiser. Now what we're going to see as new channels open up is people who might be a third-party seller just advertising on site might start to advertise on streaming TV, right? So they become new to that channel. And then you can also see, let's say, CPG challenger brands. They might start advertising in grocery stores. So all of that is kind of the new money. And when you add it up, it does add up to quite a bit. And that's why, we're at about a $50 billion plus market in the US today, but well on a path to over $100 billion in a few years.
And maybe to ask the most obvious question of all, why are retailers interested in this? Is it just the money? Is there any more to it than, wow, the margins are incredible and we've built this platform?
That's most of it. You follow the money. But you said it in what's often a thin margin business, and certainly it varies by retail segment. Grocery has notoriously thin margins, so that's where retail media is really essential. It doesn't take a lot of incremental revenue. You can have 1-2% incremental revenue that can have a really disproportionate impact on the bottom line. And, Amazon is its own beast. So, at this point, that juggernaut ad business is driving a huge portion of Amazon's profit. But we're getting visibility into brick and mortar retailers as Walmart has started to reveal more. And they said recently that essentially a third of their operating profit is now coming from advertising and related businesses. So, right, and Walmart has scaled. They're a $5 or so billion business now, but they still have a lot more running room. This business is still growing at 30%, high 20s year over year. So it's not crazy for Walmart to, very soon be a $10 billion business. And then you think about how much of that's dropping to the bottom line. Are we a few years away from, the vast majority of Walmart's profits coming from advertising? Very possible.
Well, it's also pretty nice too when you don't have to buy any physical inventory, right? That's a pretty good return on invested capital.
No tariffs on retail media yet.
No tariffs on retail media. Not yet. Just stay tuned though. So we're not going to be able to do service to this in the time that we have in an audio medium, but I did get to hear your most excellent presentation back in February when we were together at the Footprints AI Retail Media Conference, and there was just a lot of information that you share that I found very, very interesting and insightful. But one thing I wanted to talk to you, maybe you could give our audience a flavor for how you talked about not just the evolution of retail media, but really the different waves of digital advertising more broadly. So could you give our audience maybe a flavor for that and what some of the key messages you were trying to drive and what people really should understand about where we are and where we're headed?
Yeah, so I guess my sort of central piece of thought leadership in retail media, going back almost 5 years now, was calling retail media digital advertising's third big wave. And the moment the thought struck me that if Amazon's advertising business was this big and retail media was going to be starting to encroach on some of these other big channels like search and social, that essentially if you drew the growth curves of each of those overlaid on top of each other, you would start to visualize and understand just how much potential there was in retail media. So that first big wave was search, driven primarily by Google. The second big wave was social, driven primarily by Facebook. And the third big wave, retail media, driven primarily by Amazon. Now, the underlying thesis of this, which I think can easily get lost, is actually very boring. And it is that it's about measurement. Measurement moves markets, measurement moves dollars. And if you think back to what first pulled digital advertising dollars online from Google, it was the fact that it was very measurable, very, very measurable, right? You put $1 into Google, you get $1.25 out, and it makes it very easy to invest against that. That's the closed loop that drives all digital advertising businesses. It wasn't until Facebook became a performance advertising vehicle. They started out really trying to do more upper funnel advertising. So it wasn't until they went to performance and closed the loop that business really took off. And then, of course, Amazon naturally had this closed loop measurement. So that's the story of digital advertising. It's way more boring than people might think, but there's a fundamental truth to it.
And one of the things, or a couple of things that I remember from the presentation I found particularly interesting. One was, I think part of your argument for why dollars are moving so quickly into retail media had to do with some of the kind of false measurement or people maybe thinking that some of their digital advertising was more effective than it actually is. And I'll come back with my second comment on that. But could you explain, am I even setting that question up correctly?
Yeah, well, that's right. It's true of retail media and it's true of all digital advertising. So the metric that moves dollars these days is ROAS, return on ad spend. And the problem is most people misunderstand it, including many CFOs. They misunderstand it as incremental return on ad spend.
Right.
Which it's not, when you say something's a return, you expect it to be an actual return on investment. Return on ad spend is very misleading. It's actually just sales that happen and that you can attribute post advertising exposure. And the problem is many of those sales would have happened anyway. So these numbers that you hear,
and also sales are not profits. That's the other problem.
Oh yeah, you have to
for 4 decades. But anyway, yes.
Yeah, right. But these numbers are crazy when you think about it. It's $4, $6, $8 ROAS. If anybody really got $8 out for every dollar they put in advertising, that would be the greatest mechanism ever, and your revenue growth would be off the charts. But it's not. And a lot of times you have these great ROAS numbers and revenue is not growing at all. So very misleading metric, and nevertheless, people invest against it. So this is true of all three of the waves, including retail media. Now, this is what I'll say in retail media's defense. Other channels are very overinvested at this point. And so that ROAS often does not translate to growth in incremental sales, whereas all else equal, retail media networks perform very well in terms of incrementality. So it is a better overall investment in dollars. That said, there are plenty of places that advertisers can flush their money right down the toilet and not drive incremental sales. And there are then some very smart strategies where you can drive incremental sales. So it's not as simple as just putting the money into retail media and you're going to get great returns. But it's certainly more possible there, I think, than other channels at this point.
So the other I guess the second area we just kind of touched on was, I think I read this separate from the conference, was that one of the pushbacks, I guess, against retail media networks can be that the closer you are to the point of purchase, the less effective the advertising might be. In other words, if the customer's already shown up at, say, Walmart looking to buy something, why would you need to advertise so much to get them to purchase something? Because they're already to purchase. And I believe you kind of push back on that thought.
Yeah, right? I mean, I just wrote kind of a screed pushing back on this sentiment because it's bubbling up quite a bit these days. And I was like, when did we stop being marketers? The thought that an ad close to the point of purchase wouldn't be effective or doesn't have an ability to be effective is crazy to me. Now, certainly, if you just attribute everything, all those sales that would have happened anyway to it, it may not be effective. But, close to the point of purchase is exactly where you can persuade people to try a new brand, choose this brand over that brand, whatever the case may be. So I kind of delineated 10 different ways that I could easily think of advertising close to purchase that would drive incremental sales. That said, it's not a given. And certainly one of the things that we see most often in retail media is a lot of dollars go into branded search for e-commerce. And so that's actually a case where, if somebody searches for Gatorade on Amazon and then you end up clicking on a Gatorade ad, that advertising wasn't what drove you to the sale, right? It was the fact that you were already there to buy Gatorade. So there's plenty of potential for this advertising to mislead, but there's also plenty of potential for these ads to actually drive changes in consumer behavior.
We'll return with part 2 of our fascinating interview with Andrew in 2 weeks. Next week, our guest is Neil Tenzer, Tractor Supply Company's Vice President of Customer Loyalty, Insights, and Engagement, recorded live in person at Shop Talk in Las Vegas. Thanks for tuning in. New episodes of Season 10 are available each and every Tuesday, so be sure and tell all your friends in the retail industry all about us. And make sure and visit our newly refreshed YouTube channel for exclusive video and our new virtual store tours. If you liked our episode, please take a moment to give us a 5-star rating on Apple Podcasts.
And I'm Steve Dennis, strategic advisor, keynote speaker, and best-selling author of 2 books, Leaders Leap, Transforming Your Company at the Speed of Disruption, and Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant and advisor, keynote speaker, and media entrepreneur. You can learn more about me on LinkedIn. Safe travels, everyone.